Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
You can hear that read the book.
All right, hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, in case you haven't been watching really any news anywhere, even social media,
We're talking about The Bachelorette.
we're talking about The Bachelorette exclusively. The economics
Bachelor.
of the...
I don't even know which one it is
don't
right
know
now.
anymore.
Doesn't matter.
Someone's going to cry, and there's going to be a dramatic plot twist.
Most dramatic season ever.
No, but we are actually, as you probably inferred from the title, talking about what short squeezing is and the whole GameStop phenomenon we've seen recently in the stock market.
Yeah. Quick question. Short squeeze.
Yeah.
I've seen that word thrown around. That's when you get a hug from a kid. It's usually a short squeeze.
Yeah. Well, I do love hugs from my daughter, Juliana. So hello if your mom is making you listen to my podcast.
She should.
She should, because you never start them too early. So 3.5, it's time to learn about the short squeeze. But first, let's talk about how we got here. So Josh, what has been, what have you been seeing the last really couple weeks is kind of where it's been huge.
Yeah, so depending on how you first heard about it, I mean, it's been on national news, been on, watch the morning news shows, evening news shows, doesn't matter, it's there.
Social media.
And you'll hear that this company, GameStop, which if you were a kid growing up in the 90s, you may have gone to a store like this where you traded in old games and got new games or got some money for your games or bought used games. Their store
Still a store.
Brokers transactions with used game equipment, buy new game equipment.
Do we still have one in Finley?
I believe there's one in Finley.
Because I know a couple years ago there was one, and I haven't been to the mall in
I think there's one
in a long time.
It's over by the Walmart, over by the high school.
Really?
I think that's a GameStop because I went in there this Christmas and bought a Nintendo Switch from them.
Really?
Yes. Yeah.
Wow. Okay. So the whole business model of GameStop,
it's there.
We'll talk about that in a little bit.
But so this store though, right? It's been around for a while.
Yeah.
It's just
not doing
along.
well. Most of them are closing.
Doing its thing, trying to stay alive in a digital changing world.
Yep.
I mean, video games are moving online. There's less purchase stuff. Anyway, it's minding its own business, but then all of a sudden its stock price started going up.
Now I think
relatively fast.
I think the first catalyst was actually the founder of Chewy, the old CEO founder of Chewy, who's no longer at Chewy, but he joined the board of GameStop.
Right. They were
so that was like, okay, great, that can justify. Yeah. He did some good things with Chewy. That can justify maybe a little bit of a bump. So I think
they also were looking at a CEO switch in the year before or something. There's been some movement within their organization that could be seen as a positive.
But in general, the stock was trading at less than $20 a share prior to that. Less than $20 a share.
And then, boom.
Boom is right. So then the CEO, the board, Chewy board guy got in there, and that was a bump. Yep. And then, as we'll talk about today, the short squeeze occurred.
Yes.
And really, so what happened was a lot of hedge funds, which we're also going to talk about, were like, hey, just because this guy's on the board, that doesn't mean this thing's worth a lot, 20% more than it was. And they took big short positions, and a lot of them probably already had them anyway because they're like, this company's not going anywhere. Mm-hmm. So that's kind of where they were just very bearish on the outlook of the company in general. And, well, the rest is history. The stock, I think the stock's up 1,200% or something year to date.
So it's doing okay.
It's not, it's outpacing the S&P slightly.
And that's when some investors got involved from
Let's
a
not
group.
call them investors.
I'm going to call them investors because they were investing.
Speculators.
They're not speculating. They're investing money. Real money's going in there. Right or not. But they're part of a group from an online forum.
Yeah.
Reddit.
Are you on Reddit?
Reddit. I've been on Reddit.
Once this whole thing started, I created a Reddit account.
I don't have an account. I've just seen it.
So
I've been on
Reddit. Yeah, Reddit is like it's like an online forum / kind of social media, and you can read really anything.
Yeah,
but it's
so
like
you create a little
free
like,
forum,
a group or a forum where you say, hey, you know what? anybody here want to talk about donuts? And then you can have a donut forum on Reddit, and everybody would like throw stuff on there. So yeah, it's crazy.
Hey, if the Invested Dads, if anyone's a Reddit user and the Invested Dads are on Reddit, screenshot it and send it to us.
Yeah, we'll comment.
We will totally do something.
I
have an account. I can comment. So anyway, yes, that's Reddit. It's actually very popular among, it's kind of its niche user base, but it's got millions of users out there. And so anyway, there's this page which is kind of driving a lot of the action here, and the page is called Wall Street Bets. And the Wall Street Bets page is nothing new. It's actually a couple years old. But really,
that might have been why I couldn't find it. I think I was looking at Wall Street Pets, and I was getting like a bunch of animals. I don't know what. I was like, how do you learn anything from this? Yeah. I was off.
You were a little off. So Wall Street Bets is the page, and they were talking about how, they've had just stock market discussions and stuff, and a lot of speculative discussion for a long time. But really, over the beginning of this year, they started looking at what are the most heavily shorted stocks in the market. And that was really what they decided to be as a target to say, I have an idea. I bet I can make some hedge funds lose a lot of money. And we'll get into all the details of how that worked. But the word hedge fund has come up. It's all over the news. It's all over this whole discussion about GameStop specifically. Josh, what is a hedge fund?
Yeah, so there are bushes that go around your house.
Keep them nice and trim with a little... Yep.
And no, the hedge fund is what we call an alternative investment.
Right.
So meaning it's different than alternative. It's different than the normal investments like stocks and bonds.
Right.
All right. So what you do is you have this hedge fund manager who has some idea of what he wants to do to make money, and you'll pool a bunch of investments together, meaning you're going to take your money and your money and your money, and I'm going to put it in a bucket, and I'm going to invest in a way to try to earn some money. So a hedge fund takes a bunch of people's money, puts it in this bucket, and essentially just tries to do something to outperform the market. And normally you can't access it unless you're an accredited investor, meaning you got millions of dollars, or you're an institution or something. It's not just out there for anybody.
Yeah.
But they're trying to do something different than you can get in stocks and bonds.
Exactly.
And usually they make bets using options, derivatives, things you just don't normally do as a normal trader. And that's part of what their appeal is they're doing something different.
Exactly. Yeah, and they're notably extremely volatile.
Yes.
And I guess in environments where equities specifically are doing pretty well, hedge funds are kind of off the radar because they don't do a whole lot. Yep. But in times of equity turmoil, so think, the bear market from COVID in 2020, think the market sell-off at the end of 2018, obviously think of global financial crisis. Those were times where if you were a hedge fund and you had sizable strategic bets against the market, you performed exceptionally well.
Yep. The big one is The Big Short, which there was a movie and a book about and everything. And his concept was, in a sense, shorting or betting against the mortgage industry.
Yep, exactly.
And so that's a big example. There's been a lot of stuff written in even a movie about all that.
Yeah, exactly. So that's kind of hedge funds. I do want to note, if you're thinking about getting into hedge fund investing, first of all, it takes a sizable chunk of money to get, to be on their pool of available investor list. Yep. There's a big threshold there, but also they are not cheap. Now, I'm sure actually in years that they don't do that well, you probably pay an expensive fee, but not an absurd fee. But in years where they outperform, there's what's called a hurdle rate.
Yep.
And, generally speaking, I'm not going to go into details of hurdle rates, but if that investment beats whatever threshold it sets or whatever, the more it beats it, the more they earn, and there's a threshold where they just make a ton of money. Mm-hmm. And it's great for them. It's expensive for people paying it. In
the industry, kind of the well-known is called the 2 and 20.
Yep.
So they charge 2% fee.
Yep.
No matter what. 2%, they're getting that.
Which is high if you're comparing it to like a mutual fund or an ETF or even an active
Vanguard.
manager.
If you look at a passive fund like Vanguard, you're paying
basis
0.0 whatever.
Yeah. 2 basis
2%,
points.
Yeah. And then the 20 of that 2 and 20 is that hurdle rate that Austin was talking about, is if they beat whatever that rate is that they set, let's say they say we got to get a 10% return. Anything above that return, they take 20% of that.
Of the above.
Yeah.
If they get
12, that 2%, they're going to take 20% of that 2%.
Yep. Suppose they get 20%. So that 10%, they get 20% of. That's 2 full percent.
That's crazy.
And it can be billions of dollars.
Yeah. So it's a steep fee they charge for what they're doing.
So let's kind of put the brakes on a little bit. Let's say, what is selling short?
Yeah. So you'll see a lot more in the summer. There's a lot more selling shorts in the summer than there is in the winter.
And you get great deals in the winter, though.
Yes.
If you're selling shorts.
Yes. No.
In the winter.
Not those kind of shorts.
No.
Selling short. So the easiest way to describe this is to say, I think something's going to go down in value, and I want to capitalize on the movement downward.
Correct.
So I'm going to say, we're going to use Austin as an example. I'm going to say, Austin, can I borrow some GameStop stocks? That's hard to say. That's probably why they messed
I know.
up.
I kind of like. There's the meme GameStonk.
Yes, that might be how
it happened.
So can I borrow some stock of GameStop, please? Because I'm going to borrow from you, and let's say it's trading at $10.
Yep.
So I'm going to borrow it, and I'm going to sell it, and I'm going to make $10 because I sold your stock. But I promise I'm going to give you it back in a little bit. My hope is it goes down to $5. I'm going to buy it back, give you your shares back, but I just made $5 on that transaction.
Exactly.
I got cut in half. That's selling short. Is I'm borrowing some stocks, selling them on the market with the hope to buy them back in the future at a lower price.
And it only works if the price goes down.
Well, it works. It's just you didn't do your job.
If the price goes up, you're in the negative because you still have to give that stock back at the price. So it goes the wrong way and you lose money.
Yes.
So selling short it's essentially unlimited liability.
Yes.
It can be very bad.
Yeah. So if I buy a stock, my liability is I buy a stock for $10. I bought that GameStop stock.
GameStop
Oh, geez,
GameStop stock.
It's like Fox and Socks. That's my favorite book, by the way. Great riddle book. Let's say I bought it for 10. My risk is 10 goes to 0.
Yeah.
I don't get negative.
Correct.
Stocks can't go negative.
Right.
It's once I'm out, it's out.
Oil's another story.
Yeah, don't even worry about that. But when I own that stock, it could go to 0. The company could go bankrupt. I lose my $10.
Yes.
If I'm selling short, because I have to, I'm obligated to buy it back at some point to refund the person I borrowed from, my risk is, like you said, unlimited because that stock price could go to anything.
If it went to 1,000, you've got to buy it back at 1,000 and then give your stock back.
Yep.
Which then you're out the whole spread.
Mm-hmm.
And that is precisely what is happening here. So, yes. So that's selling short. You're borrowing stock and you're only hoping that it goes down. Because if it goes up, you're just out of money. Yep. That's not good. So is selling short bad for the stock market?
That's a great
It's
question.
A loaded question.
It is a loaded question. It's a hard question to answer. Is it bad? Well, in my opinion, if you look at a capitalist society where you kind of don't have limits on as smart or dumb as people want to be with their money,
right?
No, it's not bad because when you're selling short, someone's buying, so someone is going to capitalize on the upside of that. Someone's losing out on the downside, and then somebody's going to get their stock back and be just like, what happened? I just was sitting here with nothing.
Yeah.
And so is it bad for the market? I don't think it is, but I think it can be used or abused in ways that hurt people or can hurt companies in the long run.
I think it's always a check, right? So there's always if you have, especially if your company, now all stock, I wouldn't say all stocks, but I would say most stocks have some short interest in them. Mm-hmm. Some maybe could be very, very thin, but some people who are thinking it could go down. I would say that having some short interest is probably a check for the market to not get out of hand. Mm-hmm. Now, I think when it gets out of hand, which in this example, GameStop, I'm doing it too. GameStop stock had over 100% short interest. So that means
100%.
Yeah, that is it. It is illogical. But you know how you said you are borrowing that share to sell short, right? Well, I could borrow the share that you borrowed again. And then
from who?
And then someone else can borrow it from me, and then there's 3 or 4 or whatever shorts on one share of stock. Now, in the example of GameStop, I said it right there.
Yes.
There was about 140% short interest. So that means for every share that was outstanding, there was 1.4 shares sold short.
Wow.
And that was the number one short stock
Yes,
in the market.
The most shorted stock.
The most shorted stock. So all of these Wall Street Bets people, the Robin Hood traders that we're talking about, they saw this as an opportunity. Mm-hmm. They said, well, if all of this short interest is there and we go in, this is a small company. We can go in and we can buy. And when you buy stocks, the price goes up. We can make the stock go up in price because it's a small stock. All of these hedge funds these hedge funds have short positions on this stock. If we just make it go crazy, then they're going to have to, so then we're talking short squeeze. If they're going to have to buy it higher as it keeps going up to keep covering themselves. And then their buying is also going to send it higher. So it just gets parabolic.
Yep.
And that's exactly what's happened this year. And that is what is a short squeeze. Yes. The short squeeze is that there's a ton of short interest, but the price goes up, and then the people who have shorted it actually have to continue to buy it higher.
Yep. They have to keep it going.
And continuing to keep buying continues to set it higher. And we've seen this in the past, but to the level that we've seen really recently, not just in GameStop, but in a couple other stocks like AMC, even American Airlines that happened this week. It's been crazy. Mm-hmm. So that's the short squeeze. That's what selling short is, and that's how you can have over 100% short interest in a stock, and I think that's bonkers.
Crazy. The
crazy thing is, it's all legal.
Yeah.
So as we said, so selling short, that's legal.
Yes.
And what the Robinhood traders are doing, they're within the SEC legal requirements as long, I guess there's kind of a gray area for them as long as they are not intentionally trying to manipulate market prices, then they're probably fine. That's probably what they're doing. But they're going to use it as the guise.
If you just want to stick it to the hedge fund,
that's
probably legal.
That's right? What they're saying. I'm just sticking it to the man.
I'm just sticking it to the short seller over there.
Exactly. So
I mean, if you think back to like Herbalife had a big thing because there was a big short on that, and there was two hedge funds kind of battling it out on either end.
Right.
And the SEC was like, whatever.
Good luck.
Yeah. Either one of you is going to lose on this.
Yeah.
But the idea was, one of them was kind of just doing it to spite the other one, and I guess that's at least a legal motivation to say, that's why I'm buying this, or that's why I'm shorting this.
So I guess that begs the question. Obviously, so I just said, that according to SEC requirements,
as of right now,
selling short and really doing what the traders are doing, that's sending it higher,
propping it up.
It's it's legal. I'm saying legal-ish. But is it morally wrong? That's really up for you to decide.
Yes.
Like I said, the people who are doing the buying, they know what's going on.
Yeah.
They know what they're doing. They're doing it intentionally. Yeah. The hedge funds have also been taking advantage of some of these down and out companies for years.
Yeah, and some
decades.
Of them would get on the board and enforce the price lower to,
and then the profit from it.
Yeah. So there's some fuzzy stuff going on both ends. And I think, to me, I see this as a giant game of musical chairs. Somebody, when the music stops, is going to be left holding $320 shares of GameStop.
Which are ridiculous.
Which are not, in my opinion, worth that. And so somebody's going to be losing. They're betting, the individual investor betting is going to be the hedge fund. But again, there's a lot of traders moving money around, and the price moves quick.
Yeah.
You could be stuck holding. So.
Well, let's talk about that. So yes, as we're sitting here on the 29th of January, GameStop is GameStop stock.
So hard.
Woo! Ticker GME.
Just GME.
They are trading at about $320 per share. Oof. So is GameStop stock? Say that 10 more times fast.
Nailed it.
Is that worth $320 a share? No, I'm just going to say that right now. There is not one.
Wait a minute. Austin's analysis is not a recommendation for. No, wait. In this case, it pretty much is straightforward.
Yeah.
If you look at an earnings ratio,
there's no way.
Look at their balance sheet. It's a little far fetched.
It's a little far fetched. Yes, there is no way by any stretch of the imagination that this company that was trading at $20 a share a couple weeks ago is worth $320.
Nothing changed fundamentally or outlook-wise to make it justified.
In fact, they've got a couple things going against them. Number one, they are a brick and mortar video game seller and reseller.
I went there.
Brick and mortar meaning they're physical. It's a physical company, so they're not like an e-commerce company which can justify higher multiples because people like that. It's really trendy right now. It's actually, and everyone uses it. So that's strike one, brick and mortar. Strike two, they sell physical video games. And in today's environment, if you have a high-speed internet connection, you can download every single video game you want directly to your console and never leave your couch.
Yeah.
Oh, it's beautiful.
Yeah.
Now, it's faster if you plug in your Xbox, by the way. Doing it over the Wi-Fi can get a little slow.
Yeah. I need to run some network cables around is what I need.
Sometimes I move my Xbox to the room with the router just to get something to download, and then I'll put it back where it was.
There you go.
Because I don't like play online, but when you want to download something that's 40 gigabytes, you need it. So anyway, 2 strikes against it right now. Now, the tailwind is that the video game industry is growing quickly, but the things that they have going against them are not helping them. And if you even want a physical copy of a game, you order it on Amazon, and it's there the next day to your door. Now, that's pending USPS slowness, which is horrible.
Now, I will say, and I think part of maybe that Chewy appeal was you think about dog food and dog supplies, you can get that anywhere, but they found a way of doing it online.
True.
And if he can get GameStop to be the online store for video stuff, maybe they have a chance. But at $350, $320,
that's how many multiples do you want it to be? It's crazy. And even used games, like I was saying, you can have ordered to your door even from Amazon. So it's crazy. All right, so that's kind of state of where we're at, Josh. I am going to crack your face up with the dad joke of the week.
Let's hear it.
All right, Josh. Why should you never buy anything with Velcro?
Ooh, man. Velcro. Why shouldn't you buy anything with Velcro?
Because it's a total ripoff. Classic. So a lot of the traders, speculators, call them what you want, who have been, bidding the price of GameStop stock up, they've been using, really Robinhood is the main kind of vehicle.
Not the guy, but
not
the
actual
trading platform.
The fox in the Disney movie, right? Robinhood was a fox. So Robinhood's kind of the main brokerage solution that people have been using to buy and sell.
It's been promoted, for the small beginning investor as a way of getting their cheap to free trades, those type of things.
Yep. Another name that did a similar thing that we're going to be talking about is TD Ameritrade. What these companies did in the midst of all of this crazy volatility is they restricted the trading. So there were like the handful of stocks I mentioned, there were even more, but these companies said, hey, we're gonna restrict, either you can't or you can only a little bit of buying and selling of these stocks for a period of time. And this has happened actually multiple times now this week. Mm-hmm. Off and on, different people doing different things. So why did they do that? Well, there's really a couple reasons, and a couple reasons that I think are pretty shady. One reason is that these companies legitimately have capital requirements from the SEC that they have to maintain levels to cover when stocks are sold short. When there's short interest out on a stock, they've got to be able to cover that with their capital requirements.
Yeah. So my example, I borrowed from Austin, but in real life, you borrow from that trading platform, the custodian or whoever that's who you're borrowing from, not an individual person.
So they've got to have the capital requirement to cover that share, and if the shares are going up, their capital requirements are going up. Yep. So there is some legitimacy there. The other reason
I saw Robinhood had to reach out to investors to get about $1 billion of cash to help with this.
They did. They got some additional investment.
I mean, it showed you they needed cash because they were short on what they had to do. Yeah,
which probably just goes to show how sizable the swing was. Mm-hmm. Because on a normal day-to-day business operation, they're fully covered on what they need to have, and they would have never anticipated this sort of thing to happen. The other, I'm going to call it a guise that Robinhood and TD Ameritrade have used, is that they are trying to protect investors who don't know what they're doing, pretty much. They don't know what they're in for.
That's so nice of them.
And on paper, that sounds nice, doesn't it? But you know what? There are people who, A, got stuck. They wanted to sell and they couldn't, or they didn't want to sell and they were forced to do something, It was just crazy. I saw screenshots on Reddit where people were actually having positions liquidated by Robinhood for them.
Oh, wow. That does seem
It seems
shady.
wrong. It seems wrong. And in my opinion, as a capitalist, this is a free market. The market is, you shouldn't punish, or hinder or punish stupidity. Mm-hmm. Let the market do what the market will do. And if you want to ride the GameStop wave up to 1,000, it's going to pop. But
I'm sure with Robinhood, to play devil's advocate on this one because I agree with you. You restricting people's ability to make their own decision as adults seems crazy, but
it's their money.
Robinhood got in some issues in the past on how they promote their trading platform to minimize risk or to make it apparent that they're minimizing risk when really they're not. And so, they've had some issues. In fact, they had someone commit suicide a year ago or so because he was trading options and thought he had lost a lot of money and didn't realize it. In fact, he hadn't lost as much money, but the way it showed it on the screen, he thought he was, and he ended up committing suicide, which is horrible and tragic. And I think those things are probably, if you're an investor in Robinhood, because it's this new trading platform, maybe there's that concern of, hey, maybe we do need to put some place guards on. We're a little different than everybody else.
Yeah.
I don't know. But yeah, it just seems weird that you're pausing trading, have those restrictions on there.
So that's kind of something that's been going on, and it's really irked some people.
Mm-hmm. Well, and the fact that it was just these platforms. So if you're on Schwab or Fidelity or any, let's see, what's the other one? Scottrade or all those still traded.
Well, and you know what?
You're at a disadvantage.
You know who's on those platforms? It's the hedge funds you're betting against.
Yeah.
And they have the benefit, which I think is another total disconnect in the market, of those hedge funds can trade 24 hours a day. They're trading in after hours and all of that stuff on the platforms that have not restricted them. So when these Robinhood people are bidding up the price during the day, in the after hours, hedge funds are bidding it back down. And then it just happens again the next day.
Yeah, crazy.
It is absolutely crazy. So that brings up another discussion.
Yes.
After hours trading.
Yeah.
Some people can do it. Some institutions. Some people and institutions can't.
Now, I did see a commercial a while back. I don't know if this was temporary, but like Fidelity was allowing retail after hours trading for certain things. And I don't know what they were or what it was, but when I first saw that, why would you want to do that? And it just seems weird that when the market's not open, some people can still continue to place trades. I don't like it.
It seems interesting. And I think that's one of the appeals of Robinhood is the ease of trading and that anyone can get into it and it's easy to do. Now, should there be some training on some of these things, options specifically, some of these stocks? Yes, probably there should be, but it's easy to use. Mm-hmm. And I think one of the discussions is that I think I heard that this week the average holding window total for all the full stock market for a stock right now is like literally under a minute.
Average holding period.
And I'm talking, I think I heard that it was seconds.
That's crazy.
And because of high frequency trading and stuff like that.
Mm-hmm. That's ridiculous.
Where we preach, we're long-term investors.
Get it at least an hour, man.
At least 20 minutes or so. I don't know. No, I mean, long-term investors. You should hold that stock until something fundamentally changes. But that's the truth of where we're at right now. And I think it is causing some churn in the market, which is causing some volatility. So, yeah, after hours trading is a little bit of a side note. So I guess
I think that also has to do with the popularity of index tracking ETFs and funds, where that a bunch of money, I mean, historically, you look, a bunch of money's been flowing into these index tracking funds, and if they're buying as things come in and then rebalancing periodically to keep in line, I wonder if that has a little bit to do with trade volume. I'm sure it does in some way, shape, or form. So I guess another fallout of this whole situation is that people in Washington, people in the states, all of these regulators are now saying, wow, this doesn't look great. This is weird.
This doesn't make sense. Some people are going to get burnt from this. What should we do in terms of regulation? Because like we had mentioned before, as of right now, this is on top of the table. You can do this. This is how the market's set up. This is legal. Should more regulation be happening? That is the question that is not really up to us. That's up for the people we've elected to decide for us. But I guess that brings up the moral question, should short selling even be allowed? Because, okay, so obviously Elon Musk is a big name in not just the car world, but the finance world, wealthiest man in the world, right? Mm-hmm. He said something in a tweet this week about how, well, you can't sell a car you don't own. You can't sell a house you don't own. So why can you sell a stock you don't own? So I think that I don't think short selling is going to become illegal. But I think that there's going to be some look into how things like this happen and why. And one of the definite low-hanging fruits that I see is the ability to essentially, because you're borrowing, is to borrow a borrowed share. Yeah. So having anything over 100% of short interest sounds like something that's ripe for regulation.
Yep. And I think, too, transparency as well is if you're taking a short position on something, do you have any ability to affect the stock price, whether you sit on a board or something that you could, in a sense, I don't want to call it trading because it's really not. Yeah,
you're
it's
leveraging
not illegal,
it.
but you're leveraging your position to force, in the end, changes to a company that moves the stock price down that then helps you with your short position. And, I don't know, there may be a little harder to look at that because that's part of these hedge funds are activist investors pushing change that may benefit the position they have on either side.
Yeah.
That's what activist investors do.
Exactly.
They take a position and then force change in order to make some money off of it.
Oh, yeah, and they do most of the time.
Yes.
So, yeah, is regulation coming? That's not necessarily saying anything's going to change. I think this is kind of generally going to be viewed as a short-term thing. It's going to unfold itself. Here's what's going to happen. Some hedge funds are going to get burnt and lose billions of dollars.
Yep.
Some people are going to get burnt and lose whatever money they put into their account buying GameStop stock. Other people, in the middle of all of this, probably made millions of dollars.
So I was reading an article, I think it was the Wall Street Journal, but they were talking about one of the early investors in this Reddit group, and he had been buying GameStop stock.
Man, that's a mouthful.
Yes. Last year, and his original thesis was just when they do find a new people to get on the board, there'll probably be a bump in the stock price. And he's thinking, 6 to 10, $6 to $10 or whatever. He started buying it. And so he put some money into it. And he was one of those guys that would post his screenshot of his account on.
Right.
And so a year ago, way before any of this became news, he had $50,000 invested in, I forget what it was on the article, but something like that. And people are like, hey, what are you doing with that?
Yeah, sounds
and
crazy.
He pretty much had GME YOLO, I'm just, who knows?
Right.
And when all this started happening, he started continuing to post and talk about it. And he ended up having a $20 million gain on his GameStop position.
Man, I hope he sold.
One day.
Yeah.
One day. Then the next day he posted and he had a $15 million loss from that high.
Oh, wow.
And and again, it's just crazy. But in this article, they were just talking about just the craziness. And, he was one of the ones that started pushing this idea, not really to get at the hedge funds originally, his thesis, but as it grew, it became kind of this rally cry to hold the line and keep going. It was interesting, but there's some people out there, like you said, that got in at the right time, and if they get out at the right time, will walk away with a lot of short-term capital gains, and income tax.
Think about the people in this. So these are the people who hold a ton of this in their portfolio, and obviously they're probably feeling pretty okay right now. But if they got in at the right time, but they can add some Bitcoin to lower their portfolio volatility.
It would be, I'm going to diversify it out to Bitcoin because it's a little too much for me.
This is a little too much.
You know what I thought too is the outlier of this is there's ETFs that track the video game industry. We've talked about this in our video game podcast.
Yeah.
They got a bump because GameStop, I'm sure, is a piece in there somewhere.
That's a great question.
And I did see it in
GME
the
or GAME or
and
Gamer?
they've seen a little bit of a bump. Now, I'm sure whoever's managing that piece probably keeps the weighting in check, so there's probably been some selling there along the way. But man, there's an outlying effect for people who may not have realized it, who may have just been in the right industry, who experienced some fallout from this whole thing.
Absolutely.
Or if you're in the airline industry, like you mentioned, an airline gets shorted like that and its price jumps because they start targeting some other highly shorted stocks. There's an airline
Jets.
ETF. Yep. Yeah. That had a little bit of a change.
From American,
the weightings are there, but it's not like it's a 6,000% gain, but it does have an impact. So it's kind of.
But it also means the fall when things correct isn't as bad.
Yes.
So
it smooths it out.
It smooths things out.
That's why diversification matters, people.
Diversification matters.
I am spread out among all your short positions. And no, I'm just joking.
I actually think that that's something that could be a fallout, is that hedge funds are going to be more cautious.
Yeah.
They may be like, shoot, I shouldn't have. That was a little bit too aggressive. I'm gonna spread my shorts out over 10 names.
Yeah.
And it's going to help me because, yes, I'm sure that some hedge funds are just out billions of dollars.
Oh, yeah. I mean, it's already been known. Some have already announced they've closed their position out, and it costs them billions of dollars. So, yeah, it's crazy. I think
they're not earning their 2 and 20.
Yeah. The idea is hedge funds have been disliked for a while, and this just didn't help.
It kind of,
Their image hasn't changed.
They're kind of, the image that they have with a lot of people is it's dirty money, right? It's money that is made off of the benefit of someone, or, they're benefiting themselves and then hurting another company or people. So that's why people like Wall Street Bets wanted to go after them.
Yeah. Because if I buy a stock, I do well when the business does well. The stock price goes up usually because the business is growing and improving. If I short something, I'm just hoping that something bad happens.
You're wishing ill will on some company.
Yeah, which is not nice.
It's kind of sketchy. Okay, so I will leave this discussion with one hilarious tweet.
Can you short hedge funds?
Like the shorts.
I want to short.
Are you long then if you short a hedge fund?
Yeah, probably.
Net long?
Long the economy.
Long the economy. So it's just bullish to short a hedge fund. Here's the tweet I will leave you with. I know this GameStop stuff is funny, but you have to remember, this is hurting real people who own multiple boats.
Which is true.
The
saw hedge funds managers. They were on the TV like, oh, woe is me. And I'm like, yeah, is it really?
I thought that was really funny. Also, I just got back on Twitter, so if you want to follow me on Twitter, AustinAW91.
There you go.
We'll tweet it up. All right, well as...
The Invested Dads is on Twitter.
Well, of course it is.
And we're tearing it up on Twitter.
Sure are. Well, as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. And guess what? We don't talk about shorting stock. It does not help you meet your long-term goals.
Yes, that's a short-term goal.
Actually, we're not saying that's helping you. Yeah, we're just saying not in our people.
No, don't do it.
So check that out. It's free on our website. Josh, how can people help us grow this podcast?
Yep, make sure you subscribe. We're dropping a new episode every Thursday. Leave us a review on Apple Podcasts. And if you have any cool ideas or questions, if you said, hey, okay, I understand shorts, but I also heard this, shoot us an email, hello@theinvesteddads.com, and we would love to answer that question.
All right, well, until next Thursday, have a good week.
Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.